Hi everybody, welcome to my video. This is the third video of my series. Today we are going to talk about 5 common investing mistakes beginners make. To start with, mistake 1. This is my favorite, following tips and hot stocks. While we do understand that in nowadays there is too much of an information overload. Information flows through social media, Instagram, WhatsApp, Telegram, YouTube, and many more. But please be aware that these recommendations are only somebody's trick to lure you to buy a particular stock. Till the time you have done a full research and you have confidence in your research, in your analysis, and until the time you have conviction on the stock, please don't buy based on anybody else's advice. Sometimes your friends, your family, your relatives might just ask you to buy some stocks. But don't do it till the time you know what exactly is the fundamental, what exactly is the technical analysis, why are you buying this stock. So please do your own research. And in this channel, I'm definitely going to help you so that you can find the right stocks for yourself. Moving to the second mistake, no diversification. I'm sure you guys have heard the term putting all the money in one stock or in one asset class. So never put all your eggs in one basket. I'm sure you have heard it, right? So similarly, even if you're very confident of one stock, of one business, you can really be not too sure because there's so much of uncertainty in the future. One regulation, one macroeconomic factor can just put so much dent to a business, right? So please don't over diversify on any asset class or any particular stock. Whatever is your allocation on overall equity portfolio, my recommendation on any one particular stock should not be more than 5%. So a well built portfolio should ideally have 20 stocks. 5% on 20 stocks is like a 100%. That should be your stock equity portfolio. Ideally, you should not have more than 5% in any stock, even if you're extremely confident of it. That is the value of diversification. The third mistake, and something that I have heard a lot, is timing the market. Let me tell you, today, as I am shooting this video for you guys, it's 27th of August 2025. If I go 1 year back, about July 2024, the Nifty values are almost at the same level, which means in the last 13 months, there has been 0% returns on Nifty 50. So just blindly doing SIP might not be the trick for you. But at the same time, if you only think about, when I will have a 20% reduction from the all time high, only then I will invest, else I will not invest. That might also not be the best procedure. Don't wait for market corrections. You should ideally, whatever is your overall monthly investmentable amount, you should do 50% of that in terms of SIP so that it can average out the risk and the gain. That is just the base of it. To take things a bit more advanced, what you should do, if you observe that the market is 10% less than the all time high, you should allocate 25% more of your SIP. And if it is 20% more, you should allocate 100% of your SIP investable amount. Let me give you an example to not complicate this further. For example, outside of your expenses, you can invest 20,000 rupees every month for your mutual fund. So if you're able to invest 20,000 in a normal scenario, my recommendation would be to maybe do a 15,000 rupees of an SIP, even though you can accommodate to spend 5,000 more. Do a SIP of 15,000 every month. When you see a 10% correction, maybe you can do a 17,500, and once you see a 20% correction, you can do entire 20,000 or whatever is left over from previous months as well. So that is my recommendation. So don't time the market, be a very more disciplined investor. Mistake 4 that most of the people that I come across they do, which is totally ignoring the cost and taxes. Let me share an analogy with you guys. If you're investing 15,000 rupees every month over the next 15 years at a 15% compounding, your overall corpus will come to about 97 lakhs, right? Now imagine your 1% of your returns goes into brokerage and 1% goes into expense ratio, which is a 2%, 1 plus 1. Which means instead of the 15% compounding, you end up having 13% compounding for the same sum of money, which is 15,000 every month for 15 years. Do you know what will be your overall amount? It will come to about 83 lakhs, which means there is a good deficit of 14 lakhs in your overall corpus, which is a very sizable amount. So, whenever you are investing in any mutual fund, try to invest in direct funds and also check the brokerage cost, expense ratio, exit loads, because there it might be very small amount, but over a due course of time, it will be a game changer to your overall wealth journey. That 0.5% and 1% which you are ignoring around will be a big snowball effect in the next 15 years, 20 years, 25 years. So do be cognizant of that. The other thing is about the short term gains are taxed higher. So, for example, if I am talking about only the equity shares which is listed on any stock exchange in India, BSE or NSE, the short term capital gains, if you sell within 12 months of buying, is a 15% plus surcharge and cess. For the same equity shares for a long term, if you sell after 12 years of holding, the tax rate is a 10% on gains above 1 lakh in a financial year. So you see the difference? 5%. There are so many times that we are not aware of this, we are not mindful of this. We end up selling something in 11 months, and that's the reason you might be end up spending 5% extra on tax. So these small things, if you can be mindful of, if you can monitor them, that will definitely have a very big impact in terms of your overall wealth generation over a period of 10, 15, 20, 30 years. The fifth mistake is not having any long term plan, right? So, whenever you are investing, the first thing that you need to ask yourself that why are you investing? And every strategy should be tailored around that goal that you have for yourself. For example, if you are in your 18s or 20s and you are just wanting to build this to buy a car in the next 5 years, then your equity portfolio, your diversification, your stock picking ideas will be totally different with somebody who is at their 60s and is just wanting to save something for to pass as a generation wealth to their next generation. So you should be have that clarity in your mind as to why are you investing, and your asset allocation should be tailored around that. You can't have the same strategy if you have a goal of investing for 5 years versus 10 years versus 20 versus 30. Based on this timeline, there's so many strategy that will change. That comes across to the end of today's video. There are 5 mistakes that we spoke about today, friends. If you can ensure that you do not make all these mistakes over a period of time, this will have a great effect to your overall portfolio. Myself, I have also learned the hard way, and I don't want you guys to also suffer what I did because I did not have a guide to suggest me. But thankfully for you guys, I am there to help you out. So just be with me, ensure that you watch the channel, all the videos, and if you think that you have got some value from today's video, I recommend you to hit the subscribe button that you see down and to like and comment on this video. Thank you so much for watching. This is Indranil signing off. Bye bye.